You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. My name is Peter Higgins, and today I have the huge privilege of speaking with Philip O'Sullivan, former Chief Economist at Investment Bank in Ireland, and is currently an investment relations specialist in the team of Ireland Group. Hi, Phil, how are you?
Hi, Peter. How's it going? Thanks for having me on.
Not too bad, mate. It's going well here. Actually, the sun's out today, so I'm happier than I've been for the rest earlier in the week when it was raining here in Leicestershire. Now, Phil, I want to start this interview with you. Obviously, you're based over in Ireland, but I wanted to start with what spurred your first interest in investing as a young boy.
For sure. So, look, I think luck and timing had a lot to do with this, which are kind of key recipes for successful investments. I was born in Cork in 1981, down the south of Ireland. And I suppose when I kind of came of age as a teenager and started thinking about what I'd like to do with my life, there were sort of two things going on in the background. The first one was the Celtic Tiger period, as it was called. The Irish economy was flying. The second thing was we had the stock markets were flying. You had the dot-com bubble was still inflating. It was still a good bit off bursting. So there was obviously a lot of interest in investments at that time. And I guess, I was very lucky in that I was brought up in a house that was full of books. My parents would have always encouraged myself and my siblings to sort of be curious about what's happening in the world, to read a lot. And I think what would help to whet my appetite about investments is that kind of time in the mid to late 90s, was that there was kind of a golden age of a lot of really good, accessible investment books like Peter Lynch's One Up on Wall Street, Beating the Street. You've got Jim Slater's Zulu Principle books as well. And these were things that, as I read them, I really felt this is what I want to do with my career. This is, and then I decided to go study finance in the local university in Cork. And that's what kind of led me on to the career as working in stockbroking and now working in investor relations while also investing in terms of my own personal account on the side.
Brilliant, lovely. Thank you for that explanation. Now, when did you first make your very first investment and what were they? Do you remember that, Philip?
Yeah, so I mean, one of the things that I've done from the very early days has been kind of I've had meticulous records. I've always kept kind of track of trades that I've done, and when I look back at sort of some of the trades I would have put on the late 90s, it's funny just. I can see a lot of the mistakes that a lot of rookie investors would have made. I was totally overweight Irish banks because obviously, Celtic Tiger, good things could only go in one direction. I was, very much in terms of the dot-com things, I was playing with some of the Irish stocks. And, there was no real diversification in terms of, either geography or sector. And I think as well, I probably was doing a lot of the rookie things like focusing on earnings as opposed to understanding the balance sheet and the cash flow. As we all know, revenue is vanity, profit is sanity, but cash is king. And it was only later on, as it became more sophisticated in terms of my knowledge of the markets, that I kind of realized that, you can't just focus on the EPS. You need to understand really what's, behind the company in terms of what sort of a financial foundations does it have from the balance sheet and what sort of cash flow generation pedigree does it have. And these are lessons that I suppose you have to learn the hard way when you start off, unless you've beginner's luck, of course. But you do learn a lot more from the mistakes than you do from the wins, because a lot of the things that do turn out can be illusions, really. That that it was luck as opposed to skill. And it's applying that sort of knowledge from 20 plus years of investing is what's really, really important.
Brilliant. I love that reply. Now, please tell us a little bit about your experience of the booming investing era of Ireland that was coined the Celtic Tiger.
Yeah, so as I say, I was a teenager when we were having the Celtic Tiger period. For the unfamiliar, GDP here was probably growing 10% a year in that period. So it was certainly a fast-growing economy, fastest growing in Europe. Unfortunately, the Celtic Tiger kind of gave way to a period that I would probably call the Celtic Garfield, where we became very inefficient. We had a credit bubble. I think we kind of started believing our own propaganda here that we, come onto a whole new economic model, and that would have led to, a roller coaster really, because I did an undergraduate degree in finance in UCC from 2000 to 2004. What would have attracted me, apart from the subject matter, was that there was a internship element to it, which I was lucky enough to do in Goodbody Stockbrokers, which would be one of the two big stockbroking houses here in Ireland. And that was fantastic experience. I mean, for somebody who was really into investments, to be able to just go in to the equity research team, where you would be working alongside the analysts that were producing recommendations on companies. You'd be attending briefings where you could have, on any given day, anybody from the chief executive of Ryanair to the chief executive of CRH coming in to present, and discussing ideas with people on the sales desk and trading, and attending the morning meetings. When you're a rookie, when you're only 21, to have that experience was fantastic. And then at the end of that internship, I was kind of taken out for lunch by the boss and offered a job then for when I came back after finishing my final year college. And that then led to 7 years in Goodbody's. Started off in equity or economic research initially, then moved to equity research, later on to equity sales. So really, really broad exposure and great experience. But it was very much a roller coaster period. 2004, the economy was still flying. Obviously, after 2008, then we had the crash. And you learn an awful lot more when things are on the way down than they are on the way up. And that was, from a solely financial lens, that was certainly a very educational time. It was obviously a very difficult time for the country, but we've come back from that, and a lot of valuable lessons have been learned, I think.
Yeah, indeed. I wanted you to just go back a little bit and please share with us your greatest investing lessons and learnings from that particular period, 2004, 2011, if you could. Just a couple of examples, if possible.
Yeah, I guess the main thing is, it goes back to what I said, earlier. You can't just focus on the earnings. You need to, or on the income statement. You need to look at cash flow. You need to look at the balance sheet. The most disastrous investments that I would have made were companies that, it's all the rookie mistakes, in terms of, you'd look at a stock that was down 50, 60, 70% and say, oh, it couldn't possibly go any lower. And then, of course, you realize it can go all the way to zero if you're particularly unfortunate, or more accurately, if you haven't done your homework. And, I think it's, one of the two kind of key lessons that I've taken away, and there's multiple lessons that everybody picks up on their investment journey. It's to know what you own is a key one. To do your homework on it. I spend hours and hours on any investment idea I have. I tend to plug all their historic financials going back, if possible, to 2007, if it's available, into a spreadsheet. And you don't need to be an expert accountant to do anything like this or anything like that. These are literally 3 pages from the annual reports. You just type those numbers in. And the reason why I go back to 07 is, of course, that's before the financial crisis. So that's a period when, peak economic performance for the world economy. And then you can kind of see, over the 15 years we've had since then, how does this company perform in a range of different scenarios? When the economy's flying, when the economy's doing badly, does this company generate cash at all times, in all conditions? How stretched is the balance sheet, or how strong is the balance sheet? And it's just understanding those things. When I look at, the companies that, have done that, I think the common thread for virtually all of the trades or investments I've made that didn't work out, was that, I just hadn't done enough homework. And, when you look at some of the top investors like Peter Lynch, they would say, if 6 out of every 10 trades work out, you're doing really well. And if you can, pump up your, hit rate to maybe 7 out of 10 doing really well, you're going to have a transformative impact on your performance. And the second kind of key takeaway for me was really over the years has been invest, don't trade. So I kind of previously, I would have been trying to buy stocks saying, oh, I think this thing could pop. They've got results next month. I think the market, as if the market was blissfully unaware of these things. And often what would happen is the share price might move, up 5, 10, 15%. And you'd sell it and you'd say, this is great, I've made my 5, 10, 15%. But that's a terrible strategy, because you're basically, you're capping your gains at, call it 15%, but your downside risk on any investment is 100%. So you have to, so I've kind of pivoted now to, over the years, to taking a view that anything I invest in is something I want to be prepared to own forever. I guess, look, the key, the second of the key learnings that I would have had is, to invest as opposed to trade, where, I think, previously we would have, might have bought something saying, oh, I think this thing could go up 5, 10, 15% because next month they're going to have results. I think the results are going to be good. And then, if it works out, then I'd sell and take profits. But that's a terrible strategy, because it caps your upside really at that 5, 10, 15% that you're targeting. But your downside risk on any trade or any investment is 100%. So, and what a lot of people tend to do, it's a very elementary mistake that investors can make, is to take profits and not run their winners, and then instead run their losing positions because they're hoping that things turn around. So that's kind of an important one, to run your winners and not take a short-term approach. I like to hold things on a forever view, which is a good discipline. I like to buy and hold. I like to take a view that, if I'm looking at an investment and deciding whether or not I want to put it into my portfolio, that if I say, well, do I really want to be looking at this in 25 years' time and say, I'm glad I bought this 25 years ago, that's a good kind of sense check to have. And, certainly when you have done your homework, you've looked at the financials of the company, you understand their balance sheet, their cash flow generation profile, it's hugely beneficial to then, be able to say, look, this is something that's been a performer for 15 years. Management have got a good strategy. I think this thing could perform for decades to come.
Brilliant. I love that full response. Thank you very much. I want to touch on a phrase that you used earlier, and ask you a question related to that. And I think you've almost answered it fully, but I just want to see if there's any other nuances you can add. What have you added to your investing armory as a consequence of that time that you call the Celtic Garfield?
Yeah, I guess, the key takeaway really is that, when I look at the positions that I would have lost, heavily in, and at the time there would have been some of the banks, some of the house builders, and then the sort of the missed opportunities where I did have stocks that actually turned around fine. For the latter camp, I remember buying Smurfit Kappa, the biggest box maker in Europe, at a share price, I think it was about €5.50, and the share price fell to a low of about €1 during the financial crisis. And there was nothing wrong with Smurfit Kappa. It was just the markets were very nervous, very jittery. Smurfit Kappa was still very profitable, generating a lot of cash. But I think, people could get very paralyzed by fear. And the thing I should have done was to go and buy, more of it at €1. But, I didn't do that. Now, the stock subsequently came all the way back up. I think I sold it somewhere in the 20s. I think I sold about €21. So it worked out fine in the end. But, the 4-bagger or whatever it was when I sold it, it would have been much nicer if I, doubled or trebled my position at €1 and had a 20-bagger out of the incremental buying. So I didn't do that. So that was one thing which, I feel if I'd probably done extra work on Smurfit at that time and understood that that's a super business, fantastic track record, and if the market has got it valued at an absurdly low rating, that would have been something that at the time, if I had bought more of it, I would have done, if I'd done more work on it, I would have had the confidence to buy more of it, but I didn't have the confidence at that time. And on the other flip side of it, it was not being Again, it was not having put enough work into some of the positions that, in terms of house building stocks that got into big trouble at that time, that led to me holding positions that were, just weren't going to survive the crash. And, that would have avoided that permanent loss of capital. It doesn't bother me if I buy a share and it goes down, if I'm confident it's going to come back up again and then some. But when you haven't done the work on these companies and you don't understand their balance sheet or the cash flow, and then they get in trouble, then you get into the realm of risking a permanent loss of capital, and that's not a position that you want to be in. As I say, though, every investor will have those moments. There's no investor that doesn't make these mistakes. The most important thing is what you do with those lessons, what you learn from them, and since then, my hit rate, if you like, has improved, but I'm not too bothered about short-term performance as long as I can kind of see incremental progress, that every year these companies are getting stronger, their earnings are, in an upward trajectory, their balance sheet is not being in any way stressed. That those are the type of names that I want to hold within my portfolio on a forever view.
Brilliant. I love that response. Thank you ever so much, Philip. Now, I want to talk about the time 2011. You're doing very well in your job, and you decide, you know what, I'm going to take some time out. I'm going to go back to academia, and I'm going to do a 1 year MBA. What did you study, and what was the driving force behind that idea?
Yeah, so back in 2011, the economy was obviously in Ireland was on the floor. We were in EU IMF program. I'd always wanted to do a master's degree, and the opportunity cost was never going to get lower. When the economy and markets were under so much pressure, and went to UCD, University College Dublin, to do it. It was 1 year MBA. It was a fantastic experience. It was a very international class, and we were able to share lessons and experiences from around the world. One of the other things that I was keen on when I went back to do the MBA was I didn't want to disappear off the grid. I wanted to make sure my name was still in circulation, my personal brand was still being developed. So I would have spent some time doing some financial journalism on the side while doing my MBA. I was given some good opportunities. The Sunday Times newspaper, their Irish edition, the business editor is a gentleman called Brian Carey, and he gave me the opportunity to write a number of their editorials, which was great exposure. And John Walsh, who was the editor of an Irish business magazine called Business and Finance, he had me writing their markets column. So that was super experience, so a good opportunity to kind of get the name out there in circulation. And then that kind of was leveraged, if you like, because 3 weeks after I graduated from my MBA, I started work with Investec, the South African UK diversified financial services group. They had an Irish business, and they hired me as their chief economist. And certainly it was the profile that I would have had maintained and developed during the MBA would have been instrumental in them hiring me in as chief economist. So I spent the next 7 years writing on the economy, or covering the economy, and writing about doing equity research for Investec in Ireland. And then in 2019, I got the call from Bank of Ireland. So they headhunted me to join their investor relations team, which is where I still am now. And that's been a wonderful experience. I love doing that. It's really leveraging all of the sort of the skills that I've developed over the years in terms of analyzing the company, understanding what's happening in the markets, and communicating with the group's investors. So it's nice to get paid to do your hobby, in other words.
Yeah, absolutely. Now that's brilliant. Now I want to go back a little bit, if I may. 2011, 2012 was around July-ish 2011 when the markets were getting absolutely hammered everywhere, and Ireland was getting hit possibly the hardest one of the hardest in Europe. What do you recall of Wilbur Ross, the billionaire American businessman, whom with his investment company and others, other US investors, acquired a large minority interest in the Bank of Ireland in July 2011, some months after the EU IMF bailout program came into operation? They exited in around June 2014, and they made 3 times the investment they made. What was so important about that, and reasons why it was important for the Bank of Ireland Group at the time?
Sure. I should say at the start, this long precedes my employment with the group. So this is totally a personal view, but I think, from looking back, I think that was an enormously important development. The investment by a number of private investors, the ones you mentioned, there were others like Kennedy Wilson, Prem Watsa, who's one of the most respected international investors. They came in to, like, Bank of Ireland's the biggest bank in Ireland, so they would have come in 2011, as you say, and that was a huge vote of confidence because fundamentally a bank is a leveraged play on the economy, and when you have the largest bank in the country getting a big investment from internationally respected investors, that's sending a good signal to the market about how they not only view the prospects for the group but also for the whole country. So Bank of Ireland would have been the only Irish domestic bank that would have escaped, majority state ownership. The others needed significant state bailouts. I mean, Bank of Ireland did receive some investment, which was very much appreciated and necessary from the taxpayer, and they have made significant repayments of that capital since then. It's the only Irish bank that's more than repaid the taxpayer for the essential critical support that would have been given at the time. But I think in terms of the fundamental significance of that really was that it was the first of a series of big investments in Ireland right at the bottom that helped to sort of steady the ship and create this sort of groundswell of belief in the markets that Ireland was coming back. We had the investment in the banks. There was huge investment from the technology companies, like the Googles, Facebooks, Twitters, LinkedIn's. They've all invested billions in this country, and that's been transformative. And we've seen huge investment in things like medical devices and pharmacy sectors as well. So this is something that helped to get the country back, and its growth has been really, really strong. For the past 7 or 8 years or so. I mean, even during the COVID period, the economy grew 5% in GDP terms in 2020 because Ireland is massively overweight tech and pharma, and the two things you wanted to own during 2020 when COVID struck were tech and pharma. So that's been something that's been very important in terms of driving the recovery that we've seen.
Brilliant. Thank you very much. Now, you've already mentioned, getting the job and the role within the investor relations team at Bank of Ireland, which is the biggest bank in Ireland. Please, can you give our listeners an overview of the sheer scale and size of Bank of Ireland Group and the assets?
Sure. So the group would be as mentioned, it's the largest bank in Ireland. We'd be number one or number two in all key product sets. Very significant market shares, and we also have so roughly half the balance sheet though is in Ireland in terms of the loan book, and the other half is invested internationally. We have a presence in the UK. We have a full service bank in Northern Ireland and in GB. We'd be active in a number of niches. We'd be active in terms of the mortgage market. We'd be active in terms of auto finance, personal lending. There's good partnerships with the Post Office in the UK and also with the AA, the Roadside Assistance Company. And these have been very, very successful partnerships for many, many years. And we would have an international acquisition finance business, which, will be split kind of 50-50 between North America and Europe, including the UK. And we would also have some very small, but useful exposure to US commercial real estate, also like single-digit percentage exposure. So it's a systemic bank, about 9,000 colleagues, and as I say, we're focused on clear delivery of our strategic aims, and we've very, very good track record on that front.
Brilliant. Thank you for that response. Now, tell us a little bit about your role and why it's so important for your clients and investors, please.
Sure. So what investor relations does is we ensure that there's an accurate flow of information about the group going out to the market. It's to help people kind of understand the performance of the group, the strategy of the group, and everything that we do kind of, is anchored by our strategic objectives, which are to, transform the bank, grow sustainable profits. And, we're very, very focused on delivery of those things. Over the past couple of years, we've made huge progress in terms of taking out costs, in terms of improving customer experience. Net promoter scores have been trending higher, and improving returns. So that sort of, delivery has been very, very helpful. And also what IOR does is we kind of, provide the narrative, if you like, when investors kind of want to understand the performance, that it's not, an accident that these things happen, that there's a clear plan behind it, and it's, to make sure that everybody's clear on what the strategy is and what we're doing to deliver on it.
Brilliant. Thank you for that full response. Now, you mentioned Peter Lynch earlier, the famous American investor, mutual fund manager, and philanthropist. He ran the Magellan Fund at Fidelity Investments between 1977 to 1990. Lynch averaged 29.2% annual return, making it the best performing mutual fund in the world at the time. During his 13-year tenure, assets under management increased from 18 million to 14 billion. He stressed and stipulated that all investors should, as you said earlier, know what you own and why you own it. Why is this such an important statement regarding the need for in-depth research and understanding of what each of us invest in, Philip?
Yeah, no, it's so clear. I mean, I guess when I would have started as a junior equity analyst in Goodbody, I remember one of the kind of senior people on the team used to say to us, if you can't explain the company or explain the investment case for the company in just 3 bullet points, you haven't done enough work on it. And, I love that. It's the number of times I've received tips from people who say, oh, you should buy shares in XYZ company. It's great. ABC, it's the new big thing or whatever, And then you say to them, but what's it do? And you'd be surprised how often people haven't a clue what they do, but all they know is it's going up because they've heard from somebody in the gym or, at the school gate or, at the coffee machine in work that, it's going up, and that's all that they have. So I think, doing your homework on companies allows you to kind of see, actually, this isn't necessarily the slam dunk that's being presented to me. Understanding that the balance, if the balance sheet's looking a little bit weak, if they're, close enough to covenants, if their cash flow generation is pretty woeful, these are not the types of companies that I want to own. I want to own companies that are financially robust, that have strong cash flow generation attributes, and that's really what I want to focus on for my own personal portfolio. And I think, while I would say it's impossible that I would have anything resembling Peter Lynch's returns. I think if it goes back to the earlier comment or quote I had from him when he talked about 6 out of every 10 things work out. And the work that I do from my own personal investing, and all of my comments here about investing are on a personal basis, nothing to do with my day job. If I can kind of avoid those banana skins as much as possible, then the market will look after the rest, because what drives the bulk of your returns is not timing, it's time. And if you are looking to buy things on a forever buy and hold basis, and you make sure you avoid buying the garbage that's out there, then that should drive fantastic returns over time. I think the market over the long term grows about 7 to 8% a year, so on average. So every 9 years or so you should double your money, and you'll double your money in the 8 or 9 years after that again and again. So that's why I would be a big advocate for people to start early, as early as possible. It doesn't even have to be a lot of money, just whatever you can afford to put away on a long-term basis, and learn from all your experiences. And as I say, it's the mistakes you can actually be hugely valuable in their own right, much more so than the wins at times.
Given your now almost 25 years of investing experience and navigating the markets, please share with our Global Investing Matters audience what your investing methodology is, style, and how your portfolio is constructed, please, Philip.
Sure. So I'll take that in reverse order, if I may. So I guess in terms of the portfolio, when I look back at my records from the late 90s, early 2000s, I didn't have a diversification as I should have back then, and I've certainly learned lessons from there. I have a portfolio that has exposures, I think, at about 13 different sectors, which I know some people would say that's mad, that's crazy. It does work for me, mainly because I've got access to systems and things that and approaches that allow me to kind of manage a portfolio that's that kind of diverse. I have 39 names in it, so it's typically two or about three names per sector on average, and these are companies that they really fit into one of three verticals. There's the structural stories. These are things I see as mega trends for the next 20 plus years. I look at things like electrification, and then I say, right, I want to be buying companies that are exposed to copper because of that. I look at things like aging populations, and I say, look, I want to be involved in healthcare companies that are, dealing with, the what an aging but also becoming more prosperous population wants. And then I look at, areas where there's emerging, middle classes and stuff like that, and what that means in terms of future consumption growth. So structural growth stories are about a third of the portfolio. Another third would be self-help stories. These are companies that, I can see that either through M&A or through cost cutting or through investment, that they can materially enhance their performance. Also, and another one to fit in there would be companies that through deleveraging can spark a big re-rating. One example of a company I held previously that certainly delivered on that was Premier Foods, which was very heavily indebted. Was on an extremely low PE, which I think reflected the balance sheet risks. But I could see from the cash flow that this was a company that was still producing good cash flows. I could see it was a company that had a lot of new product development, and I could see that it was kind of holding its positions in terms of the market, and that stock more than doubled over the couple of years that I held it for, as it transformed its balance sheet dramatically from being a company that was very heavily indebted into a company that was carrying actually relatively low debt compared to its underlying earnings by the end of it, and the share price more than doubled. As a result of that, and other things. I mean, certainly the pandemic and more home eating would have helped as well in terms of its performance, but it really accelerated delivery performance as opposed to, was a driver of it. And then the third kind of vertical would be value stocks that I see as being fundamentally mispriced, and that I believe I'm picking up on a very attractive price relative to their intrinsic value. And I think across the portfolio, then I look for companies that have got decent cash flow generation. I think the running yield in my portfolio is probably somewhere between 3 and 4%, and that's something that produces really, really helpful cash flows because I reinvest all of those in terms of growing the portfolio over time. And as I say, I'm not too bothered about short-term market movements, because as I see it, if you just keep buying good companies at sensible prices, the time will take care of everything else.
Brilliant. I love that reply. Thank you. Now, you touched on several very important nuances there, Philip. I want to go back to one, if I may. You touched on about cash flow and dividends, and I want to just put that into one context here regarding compounding of the returns on the portfolio and why that's so important for long-term growth of the value of the portfolio. Can you expand on that for our listeners, please?
Yeah, sure. I mean, distributions are, so important in terms of driving returns. And it doesn't have to be dividend. One of the things that I look at when I'm running my screens on companies is shares outstanding. So companies that have been doing buybacks, that can lead to huge compounding value in terms of underlying earnings per share over time. So as I say, I'm not slavishly beholden to the dividend, but across my portfolio, I've got companies that have massively reduced their share count. I mean, none of this is investment advice. Clearly, this is not an appropriate forum for that. But when I look at companies like a Kenmare Resources that did a tender offer, bought back 13.5% of their shares, if my memory is correct, last year. The likes of Ryanair, which since 2007 has reduced its share count from about 1.5 billion shares to 1.1 billion shares. These things are, have a very obvious impact in terms of if you're reducing the denominator for the earnings per share, and you go to underlying performance, then the rating will follow. So that's something that I would track quite carefully, and as well the companies that pay the dividends, certainly that's very helpful in terms of when I from time to time I look at the cash that I have and say, look, I think such and such companies at a silly price, I think I'll buy more of it, and that's being able to sort of be strategic in terms of my own capital allocation on the back of what the companies are producing themselves. That's enormously helpful to be able to look at that in a portfolio level.
Thank you very much. Now, a piece of advice that every person who plays the stock market is given is, and I think you touched on it earlier, cut your losses and run your winners. Why do you think we as investors psychologically find it so hard to sell positions that are in the red? And how do you combat this yourself, Philip, in your personal account?
Yeah, it's a psychological challenge, I think, for every investor, because you convince yourself, oh, like I know it's going to turn around. As I say, I'm a terrible seller of companies, but every time I've sold a winning position, it's gone up even more. Like I would have held Wednesday previously. I bought it in around £2. It went to £4 a share. And I thought, isn't that great? I've doubled my money. And I think it was only something like 12 months or something. It was a very, very short space of time. And the share price subsequently went up, to £5.50. I didn't, and I went from feeling very, very smart and very satisfied with myself to feeling, gosh, why the hell did I sell it there? So in terms of, as I say, when you have the perspective of saying, I'm buying things on a I want to hold this forever basis, that kind of is helpful in terms of, as long as the story doesn't change. I mean, I don't mean to say that I'm, fundamentalist about this. I mean, if management announced that they're pivoting from a very sensible strategy into doing something that's completely bonkers, that, I just don't see that delivering value, then I'll cut it if the strategy has changed. But as long as the strategy is good, and as long as the prognosis for the markets that they're in is good, then I'm happy to keep running the positions. In terms of the losing positions, I'm not, as I say, I'm not that bothered about mark to market on the portfolio. I mean, if any shares are down 10, 15, 20% where I bought them, like, of course it's frustrating, but if you believe that these are robust businesses with strong business models, and they're going to deliver good growth over time, then the share price will look after itself. You don't need to worry about it. Where I would, apart from outside of if a company was to materially change its strategy and represent something very different, if I see that there's a credible risk of a permanent loss of capital, I'd immediately cut it. So that's but thankfully I haven't had too many of those the past couple of years. There was there's been one or two, like, which would have been kind of casualties of the kind of COVID period and stuff like that. But generally, we haven't seen too much of that, and that would reflect the fact that I would put an awful lot of effort into trying to understand what's behind the balance sheet. And as I say, when you plug 15 years of financial data as it is now into a spreadsheet, and you can see how companies perform in different circumstances, that's very, very helpful. Particularly, if we're going to a more uncertain time for the global economy, and you're looking at the banks, for example, and say, how did they do after 2007? And say, well, we're not in another. It's highly unlikely to be as bad as the global financial crisis was, whatever lies ahead. But if this was as bad as it got in the global financial crisis, and this is the capitalization of the European or UK banking sector today, then you'd be very optimistic that the banking sector can get through it. Whatever about the short-term performances, when you see that the capital is multiples of what it was previously, and the losses are likely to be, a fraction of, previous economic shocks, that's something that gives you an awful lot of reassurance.
Yeah, you've touched on something which I've not heard anyone else said before in the interviews or anything I've read before, and that's going back to 2007 about peak performance. I think it's absolutely fantastic that you're putting those sort of numbers in, and at the moment that's like 15 years of data you're crunching, and if that doesn't filter out the rubbish, I don't know what will. So
Exactly.
you've got a fantastic chance of hitting a home run and success with that. Definitely fantastic, mate.
Yeah, yeah. I mean, it's time consuming. But if you
Of
put in,
course.
but it's, I'd rather spend a day typing those numbers in than, going in investing blind, because there's a lot of stuff that looks cheap. And if you don't do your homework, you'll realize it's cheap for a good reason. So
Absolutely.
yeah, so there you have it.
Brilliant. No, I love that. Now, Phil, I'm going to change things up slightly here. You've got your own investment, you've got your own investment style and strategy. Have you opened any investments for your children? And if so, what type? And how does this strategy for the portfolio differ to yours at all, if any?
Yeah, I mean, without going into too much granularity on that, because out of respect for their own privacy, certainly there would, I would have, put money away for them. It would be on the same basis. I mean, the thing is that, my kids are aged between 1 and 6, and they won't need to access any of this money for a very, very long time. So that kind of enforces putting that long-term lens on it, to say that, look, maybe they don't need this money for 15, 20, 25 years. And then you're looking at companies that you believe on that sort of a view are going to be, good performers in that time, are going to grow in that time. And that's a nice lens to put over it, because you're not being sucked in by any short-termism. You're not overly bothered also about the price you're paying for things. You're not trying to be greedy and say, oh, if only that price would go down another 5 pence, that would be a great entry level. I mean, on a 20 plus year view, it's irrelevant. It's completely a rounding error.
Absolutely.
And particularly if they're a dividend paying company, you'll get all that back. And more. So I guess, I would look at that. I think the main thing I'd like to give my kids would be an interest in this, in terms of, investing, putting money away for the future. Your future self will thank you. I'm a strong believer of that. And kind of by allocating, resources now, but not just financial resources, but in terms of time, by doing lots of reading. We live in a fantastic period where we are. You can access kind of the totality of human knowledge on your mobile phone. It's amazing that you can. There's really no excuse. You can listen to podcasts like this, not like this series, and I know you've far more illustrious investors than me in your back catalogue that people can listen to. You've also got access to webinars from companies, and lots of really, really good content to understand what makes those businesses tick. A lot of companies are doing webinars that are accessible to retail shareholders, where they can ask questions directly, and that sort of ability to link in with management is really, really valuable. And as I say, if you kind of put in the time and effort, your future self will thank you. I'm a strong believer in that.
Brilliant. I completely agree with you about putting the time in, most definitely. Now, Philip, there is so much talk of inflation, recession, energy crisis impacting lives in the market at the moment. What are your views on the current pressing issues, and how are you looking to navigate them?
Yeah, that's a good question. I think what's striking is the extent to which we've been. There's a number of different factors that have come together. I mean, obviously, we've got the post-COVID dislocation, the disruptions to supply chains, particularly in the Far East. You've had economies that have been rebooted, and there's been some kind of stresses from that in terms of labor market shortages in a lot of countries, and so on and so forth. So the inflationary pressures were building in the system. You also had monetary policy where that's moved from ultra accommodative to now tightening. And then we had the invasion of Ukraine earlier this year to think about, and the implications of that. And certainly as the year has gone on, I've become more encouraged by what I'm seeing. There's been significant improvements in terms of supply chains. I know that there's still, you get the odd headline out of China that will give you pause, but certainly the supply chain pressures globally are easing. Fiscal policy is looks very appropriate, both in the UK and here in Ireland and in other countries. There's an awful lot of supports being provided by the government to allow kind of households and businesses get through what's been a very, very difficult period. And the other thing that's probably overlooked is that the buildup of savings during the pandemic has been absolutely enormous. I mean, I don't have the figures for the UK to hand, but in Ireland, since 2019, so pre-COVID, household savings are up by 33%, and business deposits are up 30%. So even if we have a period where people are going to have to, dip into their savings because they've got extremely high bills to pay, an awful lot of households and businesses, I'm not saying it's all of them now, don't get me wrong, but in aggregate, there's an awful lot of people who have those buffers that they can draw on. And that's something that's important in terms of ensuring that, a lot of, people can get through this period a lot more easily than would have been the case if there hadn't been so. So there were some kind of silver linings from some of the things we've gone through in the past couple of years, in terms of, the deleveraging that's been happening in many countries, not in all, but certainly here in Ireland, household debt in cash terms is the lowest it's been since 2005. And I think we learned a lot of lessons from kind of the period after the global financial crisis onset, and that's kind of set us up with really, really strong balance sheets, both business and household, to see through this period. And I'm happy to see that, unlike the earlier stages of the global financial crisis, that a lot of the policy settings are helpful. I mean, central banks have a job to do, that's well understood, but in terms of governments are trying to make things easier for people, and hopefully that will be really, really helpful in the period ahead.
Brilliant. Love that response. Thank you very much. Now, quite an interesting recent population data from the Central Statistics Office of Ireland surprised many by showing there's a net inward migration across all age groups, which runs contrary to popular narrative that young people are fleeing Ireland in their droves. Yeah. Philip, as an economist at heart, what in your view has been a catalyst for this?
There's a number of factors. I mean, Ireland has, for many years had a very, very flexible pro-business climate. We've had, it's very easy for companies to get visas for people to come here. That's not the case in many other countries. I think a lot of that probably rests in our own country's history of emigration for long periods. Unfortunately, our biggest export was our people. But since the country's kind of economic fortunes have turned, we've seen huge numbers of people coming back, Irish people coming back. We've seen huge numbers of people, global talent moving to Ireland. I mentioned earlier that the country, it resembles something of a floating aircraft carrier off the west coast of Europe, that multinationals who want to launch goods and services into the European single market, they can do so out of Ireland. And if they need to find people with certain language skills or other skills that are not found in large quantities in Ireland, that's something that that they can correct for that, they can solve for that. And it's just been a joy to see that coming through. It's created huge opportunities for people here, and it's lovely to see people voting with their feet and coming to Ireland in large numbers. And as I say, there's in a lot of countries there's popular narratives about what's happening, but as I say, the data do show that there's more people coming here, including more Irish people coming here, than are leaving the country. And I think there's no better kind of reflection on how people view the country's prospects than if they're willing to move to that country. So it's great to see it.
Yeah, thank you very much. Now, I'm going to ask you the question about renewables now. Okay. EirGrid published a report September 2021. Note that this is prior to the current 2022 energy crisis we're having. And they predicted that the country could face electricity shortfalls over the subsequent 5 years due to demanding rising while supply lowered due to the closure of fossil fuel fired power stations. Much of the growth of demand of energy has come from data centers. of which there's lots of tech companies in Ireland, which are responsible for 14% of all energy uses in 2021. That was a rise of 32% compared to 2020 and 265% compared to 2015. Philip, what are your thoughts, views on renewable energy and the growth of investments in them by Ireland's government and Irish businesses?
Yes. So look, I mean, Ireland is a super location for renewables. Like we're on the Atlantic Ocean. There's been billions put into building wind farms. Solar farms are now starting to be developed, and battery storage also. People laugh, I think, before they really start to think about it, at the sheer notion that Ireland would have solar, because I think most people would associate Ireland with pretty awful weather. But the thing is, we're so far north that it's actually, it can be brighter until very, very late at night in the summer, until 10:30, some nights. So that's something that's kind of allows us to position ourselves as a country that's a really, really good place to invest in renewables. There's been, there's large numbers of projects underway and planned for the coming years. And the grids, there's big investment in things like interconnectors. There's one under construction at the moment between Ireland and Wales. There's another one that's already operational. We're obviously connected through Northern Ireland to Great Britain, and there's a big interconnector being built between Ireland and France. So all these things will help to enhance resilience, and that's something that's to be welcomed.
Brilliant. Now I'm conscious of how long I've had you on this particular interview, so I've got one final question for you, Philip. I'm going to give you a magic wand, right? Having enjoyed a hugely successful career in finance and the investment industry, if you were given the ultimate power and opportunity to change, improve one aspect of investing for the betterment of all savers and investors, what would that be and why, Philip?
I think education is the key. I think there's not enough emphasis on this being put on. We do as a species face into some interesting demographic challenges in the years ahead. In many countries, including this one, the birth rate's never been lower, the life expectancy has never been higher. I think people need to invest to kind of look after themselves for the future. There's probably not enough emphasis being put on that. I'd like to see more of this type of discussion on the curriculum, and that would be kind of what I'd be pushing for. I mean, because once people are empowered to make informed decisions and can learn from them, that's something that's hugely valuable. And as I say, it's to kind of pivot away from any kind of get rich quick type nonsense and look at proper long-term investing. And sensible opportunities. I think that's what people should be shooting for.
Brilliant. I love that response, because that's exactly what we're trying to do with this particular series of investing podcasts, is to educate people to make the right decisions, become more and more informed, and learn that there's far more than one way to do this. One size doesn't fit all regarding investing, and everyone's got an opportunity to get better and improve their life chances going forward. Philip, it's been brilliant having you on this Investing Matters podcast. I want to wish you well in your current role as in the investors relations team at Bank of Ireland, and Godspeed and good strength to you going forward, mate. Take care.
Thank you. Great talking to Peter. Take care. Bye.